Right. Good morning, Amma. Good morning, all of you. Right. So now I'm going to discuss I'm going to discuss briefly about the concept of derivatives, how it works, what is the purpose, and what you read in academics, and what will be in realistic. Okay. Right. We'll discuss the brief concept about derivatives. So first of all, derivative is a contract between two parties. Derivative is a contract between two parties. In simple terms, without any technical terminology, etc. In a layman terms, derivative is a contract between two persons. Very simple. Derivative is a contract between two persons. So what for that contract? What for that contract? So that contract is for two purposes here. There are two types of contracts. Okay, the contract is for purchase or sale of something. The contract is for purchase or sale of something. For purchase or sale of something. For purchase or sale of something. Okay, some asset. So for purchase or sale of some asset, you can say for purchase or sale of some asset, or the contract is relating to purchase or sale of asset. Relating to purchase or sale of asset. This is what the point. Okay, ma? So it is a contract between two parties. So that contract is for purchase or sale of some asset, or relating to purchase or sale of some asset. Okay, there are two types of derivatives. Though people are discussing many different types of derivatives, but broadly derivatives are categorized into only two topics: purchase or sale of derivatives, and relating to purchase or sale of derivatives. It is called as a commitments. These types of derivatives are called commitments. And these types of derivatives are called claims. Only two types of derivatives. Okay, so within this is what the point. Okay, commitments and claims. Okay, so this commitments were broadly categorized into forward contracts, futures contract, and swaps. This is the important commitments. And options, we have only one type of option claims, that is called as options. So these are the two broad types of derivatives. Okay, one is commitments, another one is claims. Okay, so commitment for purchase or sale of some asset. Options relating to purchase or sale of some asset. This asset is nothing but this asset is technically called as underlying. In derivatives chapter, this asset is technically called as underlying. This asset is technically called as underlying. This asset is technically called as underlying, or in simple terms, it is the subject matter of the contract. In simple terms, what I can write is, in simple terms, subject matter of the contract. It is a subject matter of the contract. It is a subject matter of the contract, as simple as that. Technical. Don't go by underlying, etc. All those technical terms. In plain language, it is a subject matter of the contract. I have entered into an agreement to purchase land. The subject matter is land. Land is the asset which I am going to purchase. That is a subject matter of the contract. The entire relationship revolves to purchase that land only. So that is called as underlying or subject matter of the contract. This underlying or subject matter of contract can be different types. This underlying or subject matter of contract. This underlying or subject matter of contract can be broadly categorized into three types. Okay, most popular three types of derivatives here. One is financial instrument. Financial instruments. The subject matter is called financial instruments. Example: shares, debentures, bonds, etc. Example: shares. So if the subject matter of the contract is a financial instrument, example shares, it is called as financial derivative. It is called as financial derivatives. In which the financial instruments is the underlying. A financial derivative is a derivative in which the subject matter is a financial instrument. Financial derivative is a derivative contract in which the subject matter is a financial instrument. Next, second type of derivatives is commodity derivatives. Second type of underlying is commodities. Example: steel, gold, etc. Example: steel, gold, agricultural produce, agri produce, etc. So these types of derivatives are called as commodity derivatives. These types of derivatives are called as commodity derivatives. These types of derivatives are called as commodity derivatives. This is the second part. And the third popular category can be currency. And the third popular category can be currency. Okay, right. So currency. So this is the example: dollars, USD or euros, etc. USD, euros, etc. So this is the point. So this is called as currency derivatives. This is called as currency derivatives. This is called as currency derivatives. Okay, right. This is called as currency derivatives, right? So these are the three different types of underlyings. You can have different any kind of underlying: interest rates, weather. You can take underlying as a weather, what is the climate, etc., and all those things. So you can take any underlying. These are the popular underlyings. Okay, financial instruments, commodities, and currencies, right? So commitments. Now we'll discuss what is the difference between commitments and claims. As the name itself suggests, both parties has to perform their commitments. Both parties have an obligation to perform. In case of commitments, both parties has an option to perform. Okay, right. Commitments, claims. Commitments, claims. So this type of contracts is these are symmetric contracts. These are symmetric contracts. These are symmetric contracts. What is meant by symmetric contracts? What is meant by symmetric contracts? It has both the parties have equal obligation. Both the parties are equally obliged. The contract is balanced. The contract is balanced. It is not designed in such a manner that one party is in a privileged position. The contract is balanced contract. Both the parties are on the same footing. Okay, symmetric contracts. Whereas claims are, these contracts are asymmetric. These contracts are asymmetric. So these contracts are asymmetric. Asymmetric means tilted or privileged in favor of one party. One party is in more dominant position or better position than the other party. So in case of claims, one party is in a better position than the other party. Okay, maybe for that better position he has to pay some money. That's a different issue. But one party has some privileged position than the other party. Here in case of commitments, both the parties has same footing. Both the parties are of equal footing. Both the parties are on equal footing. Both the parties are on equal footing. One party is in a privileged position. One party is in a privileged or better position. One party is in a privileged position. Okay, right. So both the parties have to perform. Okay, both the parties has an obligation to perform. Both the parties has an obligation to perform. One party has to perform. One party has to perform upon the insistence of other party, upon the insistence of another party, upon the insistence of another party. One party has to perform if the other party insists, definitely. One party has to perform if the other party insists. That means the other party is in a privileged position. The other party does not have an obligation. This other party does not have an obligation. No obligation. No obligation. If this party insists, another party has an obligation. That means only one of the parties has an obligation. Only one of the parties has an obligation. The other privileged person. So obliged person has to perform as per the instructions of the privileged person. Obliged person has to perform as per the instructions of the privileged person. That is what. Okay. Great. Obliged party has to perform as per the instructions of the privileged person. Okay. Right. So popular commitments are example forward contracts. Example forward contracts. Example forward contracts and swaps. People are also discussing futures, etc., and all those things. Futures is a variant of forwards. In fact, swaps also a variant of forwards. In fact, swaps also variants of forwards. So better take forward contracts. This is called as options. Example options. Example options. So forward contracts and options. These are the two bad categories. So in case of forward contracts, the price is fixed. The price is fixed. In both the cases, the price is fixed. Only thing is that here the performance is guaranteed. Here the performance is fixed. Here the performance is contingent. In both the cases, now we have discussed the similar differences between commitments and claims, and now we'll discuss the similarities. Before going to the similarities, we'll write last one difference. So performance is fixed. Performance is fixed. So here performance is contingent. Performance is a contingent. That is the difference between forward contracts and options. Okay. So now we'll discuss the similarities, whether it is a forwards or options, whether it is a forwards or options. What are the similarities between those two? So forward contracts and options, what are the similarities? So in both the cases, contract is entered at present. Okay, contract is entered at present. Contract is entered at present. Okay, so contract is expected to be executed. Expected to be executed at a future date. At a future date. Contract is expected to be executed at a future date. The price of the contract, is fixed at the time. Is fixed. The price of the contract is fixed at the time of entering the contract. The price of the contract is fixed at the time of entering the contract. As simple as that. So these are the common points in between those two. Today we are entering into contract that will be executed in future. That will be executed in future, and the price is also determined now itself. That means we have irrespect. We does not have any regard to the future prices. The parties need not bother about the future prices because the price is fixed today itself. The price is fixed today itself. Therefore, we need not bother about the future prices. But here, the contract is expected to be executed. Whether this execution will happen or not. Whether this execution will happen or not. That is the question mark. So contract is entered today. Price is fixed today. Whether the contract will be executed or not. Executed is certain. Here it is contingent. May or may not be executed. May or may not be executed. That is the only thing. In both the cases, if at all it is executed, price is fixed. If at all it is executed, price is fixed today itself. Whether it is in forward contracts or options contract, if at all they have been executed, price is fixed today itself. But the difference lies is only whether they will be executed at all or not. Whether they will be executed at all or not. That is the difference. In case of forwards, definitely they have to be executed. In case of options, depends upon the privileged person. Depends upon the choice of the privileged person. Also called as option holder. 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 That is more, we'll discuss in detail about the forwards and options later on. While we're discussing the problems, we'll discuss in detail about this. Now I'm giving a brief. So the privileged person is called as an option holder, right? So this is the two different types of derivatives and three popular types of underlyings and two different types of contracts, commitments and claims, three popular underlyings. Now we'll discuss about the purpose. For what purpose derivatives are used? This is very, very important. Very, very important. We should know for what purpose, because knowing the subject is of no use unless until you know when to apply the topic. So this purpose will give you an insight of under what circumstances this will be applied. Under what circumstances this will be applied. Okay, so purpose of derivatives, purpose or applications of derivatives. Applications of derivatives. Our unique applications of derivatives. Applications of derivatives. So first application of derivative, be careful. There is some common misconception about here. So what the first purpose of derivative is risk management. Risk management. Risk management. This is the important point. The first purpose of derivatives is the risk management. Here in this concept, there is popular misconception. People are misreading the topic. Risk management. Risk management refers to variation of risk. Variation of risk, not necessarily reduction of risk. Most of the people are of the misconception that derivatives are used to reduce the risk. They are used to reduce the risk. No, they are a risk management tool, not risk reduction tool. Management refers to variation in the levels of the risk. That means if you want, you can increase the risk, or if you want, you can decrease the risk. For both purpose, derivatives can be used. Derivatives are not necessarily used only for reducing the risk. They can be used even to increase the risk also. Okay, refers to variation of risk, that is increase or decrease of risk. Increase or decrease of risk. Increase or decrease of risk. This is what the point. So therefore, most of the people are thinking that derivatives are only for decrease of risk. No, not necessarily. It can be even for increase of risk. In fact, strictly speaking, now derivatives are used more for increasing the risk rather than for reducing the risk. In real life scenario, most of the times people are using derivatives to increase the risk, not to reduce the risk. So I'll tell you one important point here. So derivatives are originally introduced. Derivatives are originally introduced to reduce the risk. to reduce the risk, to better manage the risk. But over a period of time, 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 derivatives becomes the very source of risk. Over a period of time, derivatives becomes the very source of risk. Derivatives becomes the very source of risk. Derivatives becomes the very source of risk. This is what the point. So derivatives are originally introduced to reduce the risk, but over a period of time, derivatives becomes the source of risk. So the derivatives become the very source of risk. That means popularly in the present day scenario, popularly derivatives are used to increase the risk with the expectation of increasing the return. With the expectation of increasing the return. That's where the difference lies. That's where the difference lies between knowledge and wisdom. Knowledge and wisdom. Okay, so knowledge is a book knowledge. Wisdom is a real life experience. Wisdom is a real life experience. Knowledge says if you increase the return. So knowledge says if you want more return, you have to take more risk. Knowledge says if you want more return, you have to take more risk. But wisdom says whenever you take more risk, it doesn't necessarily mean that you'll get more return. That is the difference. Okay, you have to understand the difference between knowledge and wisdom. Okay, so knowledge says to get more returns, more risk to be taken, more risk to be taken. So people are misinterpreting that. To get more returns, more risk to be taken. So people are misinterpreting that. So wisdom says, more risk does not necessarily result in, more risk does not necessarily produce more return. More risk does not necessarily produce more return. As simple as that. So people are now misunderstanding this concept. To get more returns, more risk to be taken. That's fine, but you have to read it completely. Every time you take more risk, it doesn't mean that you will get more return. But most of the people in the stock market, they are ignoring this concept and they are focusing on this concept in a reverse manner. Oh, more returns means more risk. Therefore, they are taking more risk with the expectation that, with the blunder misconception that whenever we take more risk, we'll get more returns. Blunder misstatement. Whenever we take more risk, we'll get more returns. That is a blunder misstatement. No, not necessarily. So that is the reason. So people with the expectation of more return, they are entering into the derivative. They are taking more risk. So derivatives are more risky. Derivatives are more risky. It has been made like that. Originally, it is introduced to manage or reduce the risk. Now it has become the very source of risk. Okay. So originally derivatives are designed. Derivatives are designed to protect investors from the risk. Originally, derivatives are designed to protect the investors, from the volatility in the underlying markets, from the volatility in the prices of the underlying. So originally derivatives are designed to protect the investors from the volatility in the price of underlying. But now derivatives becomes the very source of volatility in the underlying. Volatility in the price of volatility in the underlying market. So earlier derivatives are designed to protect ourselves from the volatility in the cash market or cash segment. Now the cash segment is getting risk from the very derivatives only. Now cash segment is getting the risk from the very derivatives only. This is what the point. Okay. In Telugu, there is one age-old wisdom or quotation which people will say that a kanche chain meste. Kanche chain meste. It is a saying in Telugu. Ancestors used to say. That means you have the protector, the kanche. That means what we call that fencing itself is eating the farm. Kanche chain meste means fencing itself is eating the farm. We have done fencing. We have done fencing to protect the farm. Now the fencing itself is eating the farm. In a similar manner, derivatives are designed to protect the cash market, to protect the people from the cash market. But over a period of time, derivatives itself is turned as a risk in the cash segment because of this lack of this wisdom. So whenever people are thinking that whenever they take more risk, automatically it will result in more return. That is a blunder statement. Okay, so don't follow that one. So therefore, the first purpose of derivatives is risk management. Sometimes people will use the derivatives to reduce the risk. Sometimes people will use to increase the risk. Most popularly in the academics, you might be seeing this. In the academics, most of the problems you will do that derivatives are used to reduce the risk. So this is the academic. Most of the problems we have done is relating to reduce the risk. But in reality, most of the volume of derivatives is to increase the risk. So really, in reality, most volumes of the derivatives is driven to reduce, to increase the risk, not necessarily to reduce the risk. Okay, that is the point you have to understand. Okay, right. So therefore, derivatives can be used to increase the risk also. Need not necessarily be, not necessarily to reduce the risk. Not necessarily to reduce the risk. This is the first point, risk management. And the second type, second purpose of derivatives is replication. Second purpose of derivatives is replication. Replication of an asset or synthetic creation of asset. Replication of an asset are also known as synthetic creation of asset. Okay, so replication of asset are also known as synthetic creation of asset. Right. Now I'll tell you what is this. What is the synthetic creation of asset? Okay. Say for example, A enters into a contract. A enters into a contract with B. Okay. So A enters into a contract with B. A enters into a contract with B. Okay. In that contract, A will be buying the share. A will be buying the asset from the asset may be share, commodity or currency. A will be buying the asset from B. A will be buying the asset from B. Okay. Right. So the price is fixed. 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 So since the price is fixed, B is protected. B is holding the asset. B is holding the asset, and the price is fixed. Okay, ma? So B is holding the asset. The price is fixed. Here where the problem comes. Okay. So as B is holding the asset, and he entered a contract, to fix the price. And he entered a contract, thereby fixing the price, thereby fixing the sale price, He does not incur any risk of holding the asset. As simple as that. I am holding one asset, say maybe share, land, etc. Any asset. I am holding some asset. I'll get the risk when my asset value depreciates in market. When my asset value declines in the market, I'll incur loss. That's okay. Okay, I'll incur loss when my asset value declines. But I don't need to worry about that because I have already entered into a contract. So today I have purchased share at 100 rupees. I have entered into a forward contract to sell at 1 or 2 rupees. That means that 1 or 2 price is fixed. I need not bother about that. That means I am avoiding the risk. I am not taking there. I am not taking any risk. So thereby fixing a sale price. So therefore holding the stock and entering a derivative. Okay, holding the asset plus entering a derivative is equal to riskless position, because whatever the risk is there in holding the asset, that risk I have removed by holding a derivative. Therefore, I ended up with a riskless position. Since now I have only riskless position, I will be entitled only for risk-free rate of return. I cannot command a premium from the other party. B cannot command a premium price from the other party because B has avoided the risk. As the B has avoided the risk and not taking any risk, he will be entitled only for risk-free rate of return. He will be entitled only for risk-free rate of return. That means, say for example, if B has some 100 rupees. Okay, so either he can go to the stock market or he can go to the bank fixed deposit, or he can put in the bank fixed deposit. After 1 year, it will fetch you 105 rupees. So in the stock also, if you hold the asset and if you enter a derivative position, it is also riskless. So therefore, here also you should be entitled only for 105. Even though we are holding the stock, but we have removed that risk. So therefore, we are entitled for the same rate of return as a bank fixed deposit. That is how the forward contracts are priced. So forward contracts are priced in such a manner that you will get only risk-free rate of return. The seller of the asset will get only risk-free rate of return. Why, sir? I am holding the risky asset, sir. Why I am getting only risk-free rate of return? You are holding the risk-free asset, but you have removed the risk of the risk-free asset. Therefore, the seller, or technically called as short position, is entitled only for a risk-free rate of return. This is the point. Okay, this is the point. So if that is the case, now you'll get a question, sir. If I am holding the stock and I'm getting only a risk-free rate of return, then what is the logic in holding the stock? I can directly go to the bank and put my money in the bank fixed deposit. If I'm getting the same amount in stock also, why should I go to the stock? here comes is, what if the risk-free investments are not available? That is the question mark. You want to invest in a risk-free asset, but that particular risk-free asset is not available. Say, for example, you want to invest in a government bond, but they are not available for trading as of now. As of now, government is not issuing any bonds. Government is not issuing any bonds. That is one point. That is one reason. So as of now, you may not be, the risk-free assets may not be available in the market. Okay. Another point is that maybe you are legally obliged to hold the risky asset. Maybe you are a promoter of a company. You cannot, what do we call? You cannot sell your asset. You are supposed to hold minimum shareholding. Maybe some legal restrictions on you to hold the asset, but you don't want the financial effects of the asset. Legally, I am obliged to hold a risky asset, but I don't want to feel the financial effects of the risky asset. The solution is the derivatives. Okay, so the derivatives results in a legal ownership without financial effect, or financial effects without legal ownership. That is the beauty of the derivatives. Okay, so we can have the financial effect of an asset without legally owning the asset. So I am not owning any government bonds, still I am getting the financial effect of the bond. I am holding a risky asset called as shares, but still I am not feeling the effect of that shares. Okay, so this is what the point. So replication of an asset. Okay, that means if this fixed deposit is not available, or if the risk-free securities is not available, still I can do this point. I can hold the, I can purchase the stock and enter a derivatives contract, so that I'll get the same effect. That means I have on my own, I have created a risk-free asset. Though there is no risk-free asset available in the market to invest, on my own I have created a risk-free asset with the help of risky asset and derivatives. So risky asset. So therefore, the conclusion is a risky asset plus derivative. Risky asset plus derivative is equal to risk-free asset. Risky asset plus derivative is equal to risk-free asset. Okay, this is what the point was. Risky asset plus derivative is equal to risk-free asset. I am holding the stock and I have entered into a derivative. The end position is risk-free asset only. I am not taking any risk because the price is fixed. That is what the point. Okay, so it is the second purpose of the derivative is replication. Those who will do that one, who will do this point, those who wants to hold the legal ownership, but don't want the financial effects of that. So here in the same example, if you look at this point, look at the contract between A and B. A enters into a contract with B. In that contract, A will be buying the asset from B. Okay, the price is fixed. A will be buying the asset from B. The price is fixed. At rupees 100 per share. The price is fixed at rupees 100 per share. Okay, ma? Right. So in the given case, the price is fixed at rupees 102. The price is fixed at rupees 102 per share. The present price is rupees 100 per share. So that means, say for example, here what happens is that during these 3 months, say for example, the contract duration is for 3 months. In India we have a maximum duration of contracts of 3 months. That is the reason I'm taking only 3 months. So if you have a 3 months contract, say 1st April 2020 until 30th June 2020, look at the position of A and B. So if look at the position of A and B during this period, A is not having no legal ownership, because A will be getting the asset from B only after 3 months. In that contract, A will be buying the asset from B after 3 months. That means as of now, I am not the owner of the asset. Legal owner, no legal ownership. But financial effects are retained. Say for example, today the price is 100. On 30th June, A has to pay 1 or 2 rupees to B, and B has to give 1 share. But in the market, cash market, the price is say 1 or 3 rupees. Or luckily, if you are very fortunate enough, the price may go to 108. So here A can sell the asset in the market, A can sell the share in the market, and he can get 108 rupees. So in return, A will be getting a 6 rupees per share profit. That means the price appreciation, even though A is not the owner of the asset during these 3 months, but still he was benefited by the price appreciation. That means financial effects are retained. That is what the point. Financial effects are retained. Even though A is not owning the asset during the 3 months, but still A was getting the benefits as if he owned the asset. As if he owned the asset. That is what the point. No legal ownership, but financial effects are retained. Even though I am not owning the asset during these 3 months, but still I am getting the price appreciation benefit. Price appreciation benefit. But in the given case, say B is having legal ownership. Legal ownership is retained. Legal ownership is retained. Legal ownership is retained. Financial effects are removed. Financial effects are removed. Financial effects are removed. Say for example, here the market price rather than 108, the market price is current market price is 100. Current market price is 100. After 3 months, market price is say decrease to 98. Decrease to 98. But still B will get 1 or 2 rupees from A. But still B will get some 1 or 2 rupees from B. That means B is not affected by this price fluctuations. B is not affected by this price fluctuations. Even though he is the owner of the asset, even though during these 3 months he was holding the asset, during these 3 months the asset has depreciated, declined in value. During the 3 months the asset has declined in value, but still he was not feeling the effect of decline. Neither he will feel the effect of increase, nor he will feel the effect of decline. That means though legally I am holding the ownership of the asset, still I am getting rid of the financial effect of the asset. That is the beauty of the derivative. You can have the legal ownership without financial effects, or you can have the financial effects without legal ownership. That is called as replication of asset. So B wants to invest in a risk-free investment, but risk-free investments is not available. So therefore he was using risky asset coupled with a derivative, resulting in a risk-free asset. Risky asset coupled with a derivative resulting in a risky asset. Therefore, the second purpose is called replication of asset. The second purpose is called replication of asset. Okay, so risk management and replication of the asset. So there are many other purpose for which derivatives are used. People will say arbitrage, speculation, etc. That arbitrage, speculation, and all those things are common for any asset. It is need not be unique to the derivatives. It is need not unique to the derivatives. Arbitrage means what? Exploiting the pricing differences in two markets. If the same product is selling at different prices in different markets, to exploiting the difference is called arbitrage. And what is called speculation? Speculation is a betting kind of thing. Speculation is a betting kind of thing. I'm just simply throwing a stone on the darkness. That's it. As simple as that. It may hit or it may not hit. As simple as that. So therefore, speculation is a very risky. Arbitration is riskless. So that arbitrage and speculation are common to any asset. It need not be with derivatives. You can do the arbitration and speculation directly with the shares or directly with the land. So today I purchase the land with the speculation that suddenly the government may announce a project here. Suddenly the prices of the land may increase. What if the prices does not increase? Yes, I have to take the risk. That I am speculating. So therefore, arbitrage and speculation are common to all types of contracts, need not be unique to the derivatives. So therefore, I am not discussing that. Though we have a couple of problems in our syllabus related to arbitrage and speculation, there I'll discuss. But overall, I am saying that those are not unique to the derivatives. So according to me, the derivatives main purpose is this: risk management or replication of an asset. Risk management and replication of an asset. Okay, right. Risk management and replication of an asset. Okay, right. So in the next class we'll discuss about some problems, how the forward contracts is priced, how the options contracts is priced. That we'll discuss in the next class. Okay, bye.